What is up, everyone? Thank you for watching this quick video. I know I did a video prior on a little bit on how to turn or to continue to make profit on by selling covered calls. I know it was a lot of depth without a ton of kind of the knowledge you need to know prior. So I wanted to dive into this video and give another example. As you can see here, I have CFII. I'm going to dive into exactly what my strategy is with this specifically so that you can start to see how I am going to be covering losses, potential losses, and how I'm going to be entering the position now and through the next 3 months, trying to make as much cash in the meantime to bring the position to hopefully net zero. I don't think I'll get to net zero by then, but I certainly will get very close to it. And as I start to explain a little bit more about selling puts, explain how this will end up being advantageous for me, a few things you need to know. So we went over, buying a stock, and then we also went over selling a call. I talked briefly on the tail end of the video about how you can do the opposite by selling a put. So it's important to know that whenever you're selling, whether it's a call or a put, two things have to exist in your account. If you're selling a call, you have to have 100 shares. Otherwise, it's naked, and I don't want to get into that. You don't want to do that. You have to have at least 100 shares of the stock before you can sell a call and collect that cash premium in the meantime. And for a put, you have to have the cash reserved to buy the stock at the agreed upon price in your account. So I'm going to go ahead and dive into the strategy with CFII. I made a quick Facebook post about it. I'm very, very involved in the growth of this company. I think it has huge potential. But CFII, just so you know, is what's called a special purpose acquisition company. So it's basically a way for an existing company to go public without using an IPO. So instead of using an IPO where you would launch on one day, it's the first day that you're trading and your shares are up for grabs all in the market at the same time. You set a valuation, you sell it at $10 a share. The cash behind the company, CFII, is valued at $10 a share. So if nothing happens, this should, it doesn't always, but before this merges, this should stay above $10 at worst. A lot of times the hype builds up and the stock will grow before the merger as well. But just so you know, that's why I'm trading on CFII. In a couple of months, this will eventually be View. That'll be the company that I own, and that's what the shares I'm buying for today will eventually merge as. But anyway, going into a little bit of detail about this. So first off, I knew I wanted CFII. There was a hype in the SPAC market. I knew I wanted at least a couple of shares to get my toes wet. So I made my first trade at market value, whatever the price was, and you can see here it was at $11.89. I know that it's probably not going to lose more than $1.89 per share. Accumulated 50 shares of that. So worst comes to worst, for the meantime, I might be down $1.89 a share, a little over $100. On the flip side, it could have potentially spiked after I purchased it, and I wanted to at least own some of the shares at a lower cost base. But anyway, so the stock actually went down, which is a good thing for what my strategy is here. My goal in CFII is to own as many shares as possible at the lowest price that what I can afford for my risk, while bringing my cost basis down. So my assumption is that by April, CFII hopefully is then View and trades at maybe $15 to $20 a share. Obviously, never know what's going to happen in the market with the election and everything else coming up, but that's my goal. So I know that I own 50 shares today. In the meantime, what can I do to continue to accumulate shares? And one of the biggest things that I'm looking into doing is what's called selling a put. So when I sell a put right here, it gives me the right to buy a share, buy 100 shares at any of these prices along the left-hand side. What this number says over here is the credit that I'll receive if the strike price, if the cost of the share for one share is below here, then my 100 shares will execute. If it's above what my strike price is, I collect the premium, but I don't get the shares, which is why I purchased 50 shares, because in the event it does continue to go up, I want I want to own the company. I'm not selling puts because I don't want to own it. I'm selling them because I want it. So what's interesting about this position is I know $10 is about the sweet spot. I don't think it'll get much lower. I'm pretty confident in that, maybe slightly, but never too much lower. And I feel the stock is going to go up. I also want to accumulate more shares. So as you can see here, I have sold 2 cash secured puts at a strike price, and my strike price was $2.30, so $2.30 per share, which is the premium. So I'm selling the cash secured put, 2 lots of them, which gives me the right to buy 200 shares at $12.50. So you would say, well, why would you buy them at $12.50? This price is only $10.89. So when I sell a cash secured put, I'm collecting the premium, which brings my cost basis down. If I were to buy 200 shares today, I'd get them for $10.89. If I were to buy 200 shares in 2 months, so February 19th, if the strike price is below $12.50, I buy them for $12.50, except I collect the cash premium over here. So I sold 2 puts at $12.50 expiring in February 19th and collected $2.30 per share. So 200 shares times 230. That would give me $660 of cash that I'm going to make in my account on February 19th. I know for a fact my account will be, I will collect the premium on those. Now there's 2 ways to look at it, and I think Robinhood does it slightly different. But let's say that the price is $12 per share on February 20th. So the contract expires, it's in the money. I now have to buy shares at $12.50, which I've already set the cash aside. I collect 600, and now I'm technically down 50 cents per share because they're trading at $12. Except I've collected around $560 in cash into my account, which actually brings my total cost, so $12.50 times 200 shares, so 12.5 times 200 is a total investment of $2,500, and divide that by 200 shares, $2,500, subtract the premium, so I collected $230 per lot, so that's minus $460. I said $560, but it's $460. Brings my total cost of my investment to $2,040, when it looks like it might have been $2,500 because I bought them at $12.50. What that means is that I'm actually getting a share price of $10.20. So if this is trading at $12, my shares are immediately in the green by over $1 a share. So on the flip side, what happens if after February 19th, this stock is trading at, say, $13 a share? Instead, I lose the right to buy my shares at $12.50. I'm no longer allowed to buy my shares. But because I sold the premium to someone who was betting against the stock, I now collect the premium on the stock. So I am collecting $430 cash into my account on February 20th, or the day after the day the contract expires. So I still have the 50 shares. I collect $430 in gain, and now my shares that are valued at 50 that cost $11.89 are now valued at $13. So another $100-ish gain there. That puts my total profit, not all realized, only 430 is realized, which means I've actually seen the dollars, but at a little over $550. So when I look at this and I ask myself, well, I want to get involved in this, but I'm patient. I trust the company. What do I want to do and how do I want to play it? Selling cash secured puts is a great way to not only own the stock, but also potentially capitalize on it. So if this closes over $12.50 after February 19th, my original investment of $589 will now be a total investment of a little over $100 to own 50 shares of a stock that I know that I want to have. So a lot of times you think, you just want to jump into a stock, you just want to buy it. That's great. You shouldn't miss out on opportunities. You'll end up buying it at a higher price. But what you need to have a plan for in the meantime is, how can I start collecting on a stock that I want to own for the future, right? I'm talking, this is a 10 or a 20-year stock that I want to own. How can I capitalize as much while it is at the price it's at today, without risking a ton of capital in my account? So obviously the downside is that if this ends up trading at $5 a share, I only collected a roughly $500 premium, and I have to pay $12.50, which means I'm down $5 per share. It could happen. Anything could happen in the stock market. You're always obligated when you're selling a put to buy the contract unless you close it out. So there is some risk to it, except when we're talking about SPACs, special purpose acquisition companies, which typically are trading at $10 a share because that's the value of the cash assets they have under their name. So that's my plan for CFII. That's how you sell it. You simply add it, continue. You want to sell one contract, good for 100 shares, set your limit price, $235. If that executes, you're going to collect $235 in your account after the expiration, if it's over, and if it's not, you'll get a discounted price on your shares once you average out the amount of dollars it is underneath of $12.50 and the premium you collected. So hopefully this wasn't too long of a video. I just wanted to go over this for you. But anyway, I will be sure to throw some more videos out there for everyone. And if you have any suggestions on content that you'd like to see, or any other, you want me to backtrack and go through things a little bit nicer, then feel free to reach out and let me know. Thanks.